This is brand new for me. The Heckam Saver. New reverse mortgage came out at the end of last year. And it seemed potentially of real interest. Basically, at very little cost, you can establish a reverse mortgage. $2,000 to maybe $5,000 or $6,000. Don't have to borrow on it. Cost, if you do, is fairly modest. I see it as a risk management tool, not as a leverage, not as a credit, not as a cash flow. But it's unlike a home equity loan, it is non-cancelable, which is what happened during the Grand Recession. They got canceled. So if it's established, and I worked with one of my associates, one of the professors at Tech, and my teaching assistant, now it's part of his PhD thesis, and ran tens of thousands of simulations. And it is a very powerful tool. So we go from a 2-bucket approach to a 3-bucket approach. So if we ever go to the point and we can cut down that second bucket from 2 years to 6 months. And if we ever use that up, then we would tap in to this reverse mortgage. The markets get better, we pay it back again. A little hard, there's a yellow line, but the red line would be just a 6-month cash flow reserve. The dotted green line, this is the survival probability, substantially increases. The fact of the matter is the loan balance, in most cases, it's always paid off over time. That's, what percent of a loan is still outstanding in the simulations. This is showing how frequently through these simulations it's likely to be drawn on. The red is none. The green is less than 20 draws. In other words, people draw, borrow it, pay it back, draw, pay it back. So most of the time, like fire insurance, you would never even use it. What's the horizon? How long is it likely if you draw on it? The red is 1 to 6 months, the green is 7 to 12 months. So even if you draw, markets recover, you're going to pay it back fairly quickly.